Welcome back to part 2 of our weekly recap for September 8-14. If you missed part 1, we covered inflation, interest rates, and jobs. Today we focus on the consumer, how people are spending or saving, and what the markets did with all this news. Consumers still spending, for now. Despite all the talk of inflation and high interest rates, one thing that stood out this week is that consumers are surprisingly resilient, especially in the United States. Several big bank executives spoke at financial conferences over the past few days, and they gave an upbeat assessment of Americans' finances. Leaders at Bank of America, Citigroup, and Wells Fargo all reported that consumer spending is holding strong. People are still swiping those credit cards and opening their wallets, particularly higher-income consumers. Even more encouraging, households are keeping up with their bills. Bankers noted that they aren't seeing unusual spikes in loan delinquencies or credit card defaults yet. In plain English, despite pricier groceries and hefty rent or mortgage payments, most folks are managing to pay on time. One bank exec said credit card customers' payment behavior looks normal and healthy. Another mentioned that auto loans had a strong summer, implying people are still buying cars, or at least making their car payments reliably. All this suggests that, for now, Americans' finances are robust enough to handle the challenges, perhaps helped by the strong job market we had until recently, some leftover savings from the pandemic stimulus days. And frankly, a lot of people determined not to scale back their lifestyles if they can avoid it. However, there's always a however, this sunny view from bank balance sheets comes with caveats. First, the spending is uneven. Economists note that higher-income households are driving a big chunk of the consumption, while lower-income families are feeling more of a squeeze. Second, there are signs that cracks might be forming if you look forward. For instance, a new survey, the 2025 My Money survey by Yahoo Finance Marist, revealed that 1 in 3 Americans say their financial situation has deteriorated in the past year. Think about that. 1/3 of people feel poorer or less secure than they were a year ago. That's a significant chunk of the population experiencing financial stress. The survey also found that nearly 45% of adults describe the cost of living in their area as not very affordable or not affordable at all. So while wages have gone up and inflation has come down from peak, many people are still underwater when it comes to day-to-day affordability. This kind of financial pessimism often leads to changes in behavior, cutting back on non-essentials, hunting for discounts, postponing big purchases, etc. Indeed, some retailers and analysts are noticing consumers becoming more price-sensitive. For example, discount stores and store brand products are doing well because shoppers are trading down to save money. We also got a hint of caution for the coming months. Deloitte released its annual holiday shopping forecast this week, and it predicts holiday retail sales will grow at the slowest pace since the pandemic era. They're projecting only about a 2.9% to 3.4% increase in U.S. holiday spending this year, November 2025 through January 2026, compared to last year's holiday season. Last year saw about 4.2% growth, and in the pandemic, post-pandemic years, we had some big jumps like 7% plus. So this would be a noticeable slowdown. Why the meager outlook? Deloitte cited macroeconomic uncertainties. Basically, people are uncertain about the economy, jobs, and still facing inflation essentials, so they might tighten their gift budgets. Another factor, the lingering effects of volatile trade policies, those tariffs again, and inflation mean goods are pricier, and some consumers might pull back volume even if dollar totals rise a bit. Interestingly, a separate PwC survey suggested we could see the sharpest drop in holiday spending in years, particularly among younger shoppers. Gen Z plans to spend less. It seems many consumers did some early buying or are saying, you know what, this year we'll keep it modest. Some experts think shoppers might front-load purchases, buy earlier than usual, to avoid expected price hikes. If they anticipate tariffs could raise prices on imported toys or electronics, for example, they might buy now rather than December. For retailers, this mix of behaviors is tricky. Some big stores, Target, Best Buy, have been cautious but okay with forecasts, while others, like Walmart, actually raised their outlook, meaning even in a slowdown, they might grab more market share as people seek value. We'll see, but from a personal finance perspective, if you are someone who splurged a bit last holiday season, you might be planning to dial it back this time, a sentiment a lot of people apparently share. UK consumers feeling the pinch. Turning to the UK, consumer behavior is telling a similar story of caution, with a side of resilience. British households endured a brutal cost of living crisis over the past 2 years. And while inflation is lower now than the worst of 2022, prices are still climbing faster than wages were, until very recently. A report from Barclays on UK spending, covering late summer, indicated that consumer spending was up only about 2% year-on-year in late August. When you consider that UK inflation was around 6 to 7% earlier in the year and around 4% by end of summer, a 2% rise in spending means in real terms people likely bought less stuff. In other words, Brits are either cutting volumes or shifting to cheaper alternatives because their pounds don't stretch as far. Indeed, there's evidence of more frugal behaviors, seeking sales, using coupons, eating out less, etc. High food prices in particular have forced many to change grocery habits, buying more store-brand items and fewer luxuries. The phrase summer slowdown popped up in analyses. The UK economy had a bit of a cool-off as consumers retrenched after a burst of spending earlier in the year. Perhaps when the sun finally came out, people treated themselves, but then looked at their bank statements and thought, whoa, better ease up. Consumer confidence surveys reflect a mixed mood. Confidence is off the rock-bottom lows of 2022, when energy bills and inflation fears were peaking, but Brits are hardly upbeat. They're worried about paying bills, interest rates on mortgages, and the general economic outlook. A particular group in focus this week was renters. A new survey by Bloomberg Intelligence found that financial worries are mounting for Britain's renters. While overall household confidence has inched up from the depths, perhaps homeowners feel a tad more secure now that mortgage rates aren't rising as steeply. Renters feel left behind. With rents climbing and no benefit from interest rates, higher rates hurt renters indirectly because landlords pass on costs, but renters don't get the upside of savings interest or anything. Tenants are feeling a serious squeeze. Many report having to devote an ever larger chunk of income to rent. And some are cutting back on other spending or dipping into savings, if they have any. The survey underscored a two-tier situation. Homeowners, especially those on fixed-rate mortgages, have seen some stabilization, whereas renters are still in the thick of it financially. It's a cultural shift, too. More young adults may consider staying with family longer or doubling up with roommates to save money, reversing the pre-pandemic trend of seeking one's own flat. Despite the pessimism, British consumers haven't completely shut their wallets. The same way Americans are still spending on experiences or treats, post-pandemic, you only live once mentality dies hard. Brits too splurged on travel and events over the summer, and pubs and restaurants saw trade when people had reasons to celebrate. Hello, bank holiday weekends. But as autumn sets in, it appears pragmatism is taking hold. Many UK households are now planning for winter and concerned about energy bills. Even though energy costs are down from last year's crisis levels, they remain high historically. We might see a renewed emphasis on saving in the months ahead, if they can afford to save at all. One positive note, UK savings account rates have improved a lot in the past year thanks to higher interest rates. There are now a record number of savings products on the market. Banks are competing for deposits and offering attractive yields relative to recent years. The average easy access savings rate is around 3.4% now, which is much better than the near 0% of 2 years ago, even if it's dipped slightly from last month. That means diligent savers can finally earn a bit of return on cash. And indeed, some consumers have been padding their emergency funds or keeping money in savings rather than investing or spending to have a buffer. In the UK, personal saving had fallen during the worst of the cost crunch. People had to use savings to cover expenses. But with wages rising and some government support earlier, things stabilized somewhat. Still, not everyone can save. A lot of lower-income families are essentially living paycheck to paycheck with little left over. Mixed signals. Reality versus perception. It's fascinating that this week we got somewhat conflicting signals. Banks say consumers are financially sound and spending, but surveys say people feel strained and intend to cut back. How do we reconcile this? It could be a timing issue. Bank data looks at what people did in recent months. Swipe those cards, pay those bills, whereas surveys and forecasts look at what people say they'll do next. Tighten the belt. Often sentiment can lead actual behavior by a bit. We might be at an inflection point where the high interest rates and cumulative inflation of the past years are finally causing a broader slowdown in consumer activity. So far, consumer spending has propped up economies and staved off recession. People kept buying despite hardships, using savings, running up some credit, or getting pay raises. But as excess savings dry up and borrowing gets expensive, we may see a more frugal consumer emerge. Indeed, one key development on the horizon in the US is the resumption of student loan payments. After a long pause during COVID and its aftermath, federal student loan bills come due again starting October. That will siphon some spending power from millions of Americans who will now have to divert money to loans each month. Analysts warn this could modestly dent retail sales and services spending. On the other hand, it's not doom and gloom. Unemployment, in the US especially, is still low historically, and when people have jobs, they tend to spend. The latest data shows US consumer confidence dipped in early September, which aligns with the caution narrative. People are worried about jobs and inflation, and hearing a lot of negative news can do that. But confidence is a fickle thing and can rebound if, say, inflation comes down more, or if a feared recession doesn't materialize. Bottom line, consumers are the engine of both the US and UK economies, and right now that engine is still running, but perhaps not at full throttle. We're seeing hints of belt tightening, slower growth in retail sales, more bargain hunting, surveys saying I feel worse off. Yet concurrently, household finances overall aren't collapsing. Default rates remain low, many people still indulge in travel or dining out, and credit card spend is actually up. It's a bit of an economic paradox, but it boils down to this. The average consumer is okay but anxious. They're juggling higher costs with higher income in some cases, and using credit wisely for now. This next holiday season will be a real test of consumer strength. Keep an eye on whether retailers start offering heavy discounts early. That'll be a sign they sense shoppers are becoming scarce. And if you personally are feeling the pinch, know that you're far from alone. A lot of folks are right there with you, reworking budgets and priorities to adapt to the new normal of the post-pandemic economy. We've talked about spending, but what about the source of most people's spending power? Jobs and paychecks. Next up, the labor market and wage updates, where we're seeing some notable changes.